Imagine you are staring at a bank balance that shows $10,000 set aside for a business idea. Picture the mixture of excitement and dread that arrives in the same heartbeat. You feel like you finally have a runway, and yet you also sense a cliff edge. When the number looks big and small at the same time, it creates a strange clarity. I have spent too much time thinking about money and business ideas to not notice this feeling. My own early attempts taught me that intention without structure usually becomes regret. This short conversation will be practical and candid about how to decide if $10,000 is worth spending on a startup. If you want a crisp decision framework, you will get one here. Before you spend a single dollar, stop and ask what problem you are really solving. After you answer that question, the rest begins to fall into place. Have a clear statement of the customer you intend to serve and their pain. Most founders confuse a solution with a market and then wonder why sales do not follow. Many great ideas are lovely in theory and empty in practice. Some of the most valuable early work is simply talking to potential customers and listening. A simple validation call can cost nothing and save everything. Every conversation should aim to learn whether a real person would trade money for what you plan to offer. That insight is the single most important predictor of early traction, because selling validates demand, and demand reduces risk. Now consider dividing the $10,000 into distinct buckets before you spend it. In one bucket, include the minimal viable product or prototype costs. On another, allocate funds for customer discovery and marketing experiments. With a third, keep a small emergency buffer for unexpected but common early mishaps. Without a plan, money becomes a smokescreen that hides uncertainty. Instead, make a spending plan that maps to specific learning objectives. Also, estimate how long your $10,000 will actually keep operations running. Often founders assume money lasts longer than it does because hope is a persuasive budgeter. Rarely will a vague plan survive the first month of real customer interactions. Surprisingly low-cost experiments often reveal more than expensive development cycles. Clearly, you should test the riskiest assumptions first and cheaply. Practically, this means building the smallest version of your offer possible. Financially, focus on converting test users into paying customers, even if the price is tiny. Emotionally, the result is that you gain confidence or you get an early stop signal. Logically, the cheapest test gives the fastest feedback, and that feedback preserves capital. Strategically ask what would make you confident enough to scale with additional investment. Tactically plan for metrics that prove progress and do not rely on vanity measurements. Operationally decide on one or two primary performance indicators that matter most. Marketing should be measured by actual conversion rates and cost per acquired customer. Product development should focus on unit economics that improve with scale. Pricing experiments are especially revealing because people vote with their wallets. Sales conversations often teach you about product market fit faster than analytics. Culture matters too, because your early habits will determine your future resilience. Leadership tone set in the first months affects hiring decisions later on. Systems for bookkeeping and simple legal protection are non-sexy but essential. Contracts with early partners should be clear and short to reduce future friction. Regulation cannot be wished away, so check any licensing or compliance needs early. Competition analysis is not about copying but about understanding where value is captured. Customer acquisition channels differ by industry, so test multiple channels before committing. Time is the invisible expense, so estimate how much of your time the project will demand. Energy is real capital, so factor in personal bandwidth and mental overhead. Support from family or co-founders changes what $10,000 can reasonably achieve. Risk tolerance varies, and that variance should guide how aggressive your initial moves are. Opportunity cost is the money you do not earn while working on the business instead. Scenario planning helps because it shows best case and worst case timelines. Sensitivity analysis is useful to see which variables break the model first. Forecast modest conversions and conservative growth until proven otherwise. Runway calculations should assume lower revenue and higher expenses than your optimism suggests. Hire only when revenue and margins justify the incremental cost. Outsourcing can accelerate progress, but also introduce quality and communication trade-offs. Freelancers are often a cost-effective way to build without heavy commitments. Automation tools can substitute for headcount in predictable processes. Branding matters less in the earliest experiments than clarity of offer and delivery. Customer service quality often becomes the competitive advantage in early days. Retention beats acquisition when you start to understand customer lifetime value. Lifetime value must exceed acquisition cost by a healthy margin for the model to scale. Unit economics should be positive at small scale before you chase growth. Cash flow timing is as important as profitability in the first year. Payment terms, invoicing, and refunds feed directly into solvency and stress, Lean accounting practices create transparency and better decision-making. Tax and legal advice are investments that prevent costly mistakes later on. Insurance may seem optional until an accident becomes expensive and distracting. Mentors and peer networks provide perspective that rescues bad assumptions early. Benchmarking against similar businesses reveals realistic expectations for growth rates. Milestones give you permission to spend the next tranche of capital responsibly. Gating spend on hitting validated milestones reduces the chance of wasteful allocation. Decision rules like stop-loss points prevent emotional escalation of failing bets. Scenario-based checkpoints allow you to pivot without losing your entire $10,000. Learning quickly is your best insurance for early entrepreneurial risk. Experimentation must have a designed hypothesis, measurement plan, and exit criteria. Documentation of experiments creates a learning asset you can reuse as you iterate. Narrative clarity helps when you explain progress to potential partners or investors. Pitch practice clarifies the value proposition and reveals obvious weaknesses. Storytelling should be honest about risks and realistic about near-term returns. Trust builds faster with transparent reporting of what was invested and what changed. Community feedback often uncovers hidden use cases or overlooked problems. Pricing psychology suggests offering small tests that lower the barrier to first purchase. Payment friction kills conversions, so simplify checkout and reduce steps to pay. Channels like direct outreach often win over passive content in early stages. Content marketing is an investment in the long game and needs consistent cadence. Paid ads can accelerate learning, but beware of scaling unprofitable funnels. Partnerships can open distribution channels but require alignment in incentives. Equity offers to partners should reflect measurable contributions and expected outcomes. Intellectual property matters more in technology-heavy businesses than in service models. Documentation of ownership reduces conflict and protects optional future funding. Hiring should prioritize curiosity and adaptability over polished resumes early on. Culture of iteration reduces fear of making imperfect initial products. Customer testimonials validate claims and accelerate trust with new prospects. Product roadmaps must remain flexible when early customer data suggests a pivot. Conserving capital is often more valuable than chasing premature scale. Rainy day funds prevent desperation decisions that erode long-term value. Personal financial cushions allow bolder business experiments without catastrophic personal risk. Exit options exist beyond venture capital and should be considered in early strategy. Revenue-first models create optionality and make future capital raises easier. Grants and non-dilutive funding can stretch $10,000 significantly. Crowdfunding is both a marketing channel and a validation tool when executed correctly. Licensing and white label deals may convert your early product into recurring revenue. Franchise or replication models can be powerful, but require systematic processes from the start. SaaS products benefit from high gross margins and predictable subscription revenue. Service businesses often need less capital upfront and can bootstrap to profitability. E-commerce models face inventory and fulfillment complexity that increases cash needs. Local businesses benefit from community relationships and tangible trust building. Consulting offers immediate revenue but often trades time for money without scale. Hybrid models combine predictable, recurring revenue with higher margin bespoke services. Clarity about your preferred model reduces wasted experimentation and misaligned hires. Metrics matter because they tell a clearer story than hope and anecdotes. Cohort analysis reveals whether improvements are real or random noise. Pay attention to churn rates because retention amplifies acquisition efforts over time. Break-even analysis forces you to face the true targets for sustainability. Gross margin targets help you design product and pricing decisions that scale. Scenario planning with worst-case liquidity paths keeps the team calm under pressure. Investing $10,000 wisely begins with disciplined curiosity and rigorous testing. Choosing to spend that money without measurable experiments is gambling, not entrepreneurship. Committing to a sequence of validated steps converts uncertainty into manageable risk. Deciding to pause and validate preserves optionality and protects future opportunities. Accept that some ideas will fail and that quick, intelligent failure is in fact progress. Celebrate learning as an outcome because knowledge compounds and creates better decisions. Trust the process of testing rather than the charm of a single polished prototype. Decide with humility and data and not with the fervor of a good story. Act with courage when evidence supports scaling, and with restraint when signals fade. Measure what matters, protect your runway, and be relentless about learning. Reassess your commitment after each milestone, and allocate the next tranche of capital accordingly. Choose to spend $10,000 only when your plan turns assumptions into validated outcomes. Decide now whether your $10,000 will buy you knowledge or merely a fantasy. Commit to honest experiments, and you will either find a real business or valuable lessons. Learn faster, lose less, and build a company that can actually pay you back. Trust that disciplined small bets will compound into meaningful options over time. Finish with clarity on whether you are funding a hypothesis or financing a habit. Conclude this moment with a decision you can justify to yourself and to those you trust.